Hello and welcome. Today we have Shane Balkham, who is Head of Research and Portfolio Construction at Beaufort Investment. Shane's going to be talking about developments in the markets and investment portfolios since the last one of these series. So first of all, Shane, what did we think was going to happen in the last quarter?
We thought there'd be some changes. Obviously, 2017 was a very calm year in market volatility. We had 9 of the 10 lowest recorded ever measures of the volatility index last year. So it was abnormally calm. So we did expect some increase in volatility. I think you have to be careful what you wish for, because we did have that. And our main concern shifted from politics to central banks. We were going to have a change in the US Federal Reserve with Jerome Powell replacing Janet Yellen. And there's expected changes coming through next year for the ECB and the Bank of England as well.
So having said that, what did actually happen?
Well, we did get the increased volatility. Market highs peaked on the 26th of January, and since then we've had a lot of volatile marketplaces. What we've had is more than 1% movements in the S&P 500. We've had 26 of those so far this year, and we only had 8 throughout 2017. Just shows you the increase in volatility there. We think that's down to more uncertainty in the marketplace, predicated through changes in the central banks that we were concerned about. So Jerome Powell did come in. Yep. He did keep the rate rising schedule intact with a rate rise in March. There's expectations for another rate rise in June and another 2 further on. Now, our concern is if data does change, if inflation does get higher or lower or some other metric changes, will they put the handbrake on? Will they pause, such as Janet Yellen has done in the past? We don't know what they're going to do. That's a level of uncertainty for us in the marketplace at the moment.
What did we do with the portfolios as a result?
We made some changes mainly to UK equities and fixed interest. What we've done recently over the last 18 to 20 months is still have exposure in the areas we want to, but be a bit more defensive in the construction of the portfolios. So still have access and exposure to equities and fixed interest, but the fund managers we're choosing typically more defensive than we would have previously had in earlier in this market cycle.
So having said all that, what happens next?
We think the year will still continue to be volatile. So far, positive returns have been hard to come by. Major equity indices have been down for the year to date, and bonds also providing negative returns. We think the market will grind higher, but it's all going to be predicated around central banks and the forward guidance they can give us.
Well, Shane, thanks very much. I'm sure our viewers have found that a very helpful, brief summary, and thank you once more.